Okay, welcome to December performance, folks. We're seeing a little softness today, but maybe it should be expected after a very strong month that was November. We talked about it being the best month of performance in Toronto so far this year, best month in the U.S. going back to last summer. And then when you look at the tail of the tape for the year overall, at least the headline numbers show around 4% gains in 2023 for the TSX. It's closer to 19% for the S&P 500. But is that really the right assessment of what's been going on? Let's bring in Jeffrey Kleintop. He's Chief Global Investment Strategist at Charles Schwab. And it's nice to see you, Jeff, and it's a great time of year to kind of think about portfolio positioning. But let's just start with the headline that the S&P is crushing the TSX this year. In your opinion, is that accurate?
No, I don't think it is. And I think the best way to think about this is that the average Canadian stock is outperforming the average U.S. stock this year. And the reason I say that is I'm looking at the equal weighted indexes. So the equal weighted S&P 500 versus the equal weighted Canadian index. I'm just use the MSCI Canada, for example. What it's telling us is that the U.S. market is so concentrated, 30% of the market cap in just those 7 magnificent tech and consumer-related stocks that have done very well this year. But the rest of the market in the U.S. is not. There's a big difference between the AI haves and the have-nots, the artificial intelligence stocks versus everything else. And what we're seeing is that when it comes to everything else, Canadian stocks are actually outperforming. And one of the reasons, I think, is that you've got Canadian stocks just priced for a more difficult economic environment that we're in. The PE for the MSCI Canada index is about 12. So you're paying 12 times forward earnings versus 16 or 17 times for U.S. stocks. So very different. I think there'll be some convergence there, and we'll continue to see this average outperformance by Canadian equities.
And just to add for our audience, I mean, a market cap, what a valuation of a company looks like in some of these indices ultimately influences how the points add up. You mentioned the S&P 500 and the influence of those magnificent technology stocks. I mean, when you look at the top 10 in Canada, yes, there's a technology company in there, Shopify, but you've got a lot of banks, you've got some pipeline players like Enbridge, you've got some rail operators like CP and CN. So that's the context just to give to our audience about when you're looking under the hood and taking a little bit of the tech out of the equation. When you look at the road ahead then, when you look at the dynamics that we keep talking about, the economy, interest rate policy, the geopolitical story for 2024, do you think Canada is in a reasonable place to outperform the U.S.?
I think it is. You know, when you take a look at the breakdown of the markets and again, how it's priced, I think it is well positioned, particularly versus the U.S. market. Look, it's going to be a difficult year next year. It's not like we're going to see some V-shaped recovery in global economic performance. I think this manufacturing recession, something I've been calling a cardboard box recession, is likely to linger at least into the first half of next year. The services sector is beginning to slow down as well. So we're looking at a fairly lackluster earnings and economic environment, one in which the valuations of stocks, I think, is going to really matter. And those higher valuations in the U.S. across sectors is, I think, going to be a bit of a drag. I just note this morning we got the job tally in, much stronger numbers here on the headline here for Canada. But I think if you look under the surface, we had a decline in average hours worked that more than offset the increased payrolls and wages. And so I think what you have here is a slowing picture in Canada and the rest of the world. Though Canada's inflation rate coming down more sharply, I think the Bank of Canada will be more quick to cut rates and provide stimulus to the economy than the Fed will. That might be another driver for Canadian equities.
Can I just stay on that for a second? Because you brought a chart to this conversation today, which I want to show with our audience. Now, everybody's got an opinion on interest rates, but we want to show what one well-sourced organization, the OECD, currently has, I guess, with the projections for models about what's going to be happening to rate policy going forward. And I believe, correct me if I'm wrong, Jeffrey, I know there are a lot of people that are starting to become very dovish and are anticipating a dramatic reduction in rate cuts. But when we look at the trends, both for countries like Japan and the United States, and then moving on to Canada, the UK, et cetera, what do the charts tell you, and what do you think market participants have to think about?
Yeah, so it's amazing, right? Usually when we get a big surge in rates like this, and rarely do we, but any kind of rate hike series, we get the same thing on the downside. It looks like a mirror image. That is just not the case this time. Both from the OECD here that you see the forecast of, but it's true in the market forecast for futures, interest rate futures as well. A very mild rollover rates, truly higher for longer. And I think what this means is that those stocks that generate a lot of their return from liquidity, certainly those AI stocks would fall into that category, many tech stocks too, they are going to see an environment where maybe there's not as much liquidity and they may not perform as well as investors are considering here as they're looking out to 2024. So I'd say in light of this environment, again, preferring sectors like financials or energy, areas that make up more of the Canadian stock market than they do in the U.S.
So just to clarify for audience, because financials, energy, materials, these are the three juggernauts for Canada's market. Your general view is, in terms of the performance from those groups heading into next year?
Those are our three favorite sectors for next year.
Oh, okay.